Hey everyone, and welcome to a brand new explainer right here on the GAAP Advisors Ind AS Clinic YouTube channel. We're absolutely thrilled to have you with us today because we've got a fantastic, highly analytical breakdown lined up for you. Today, we're taking a surgical look at debt securities and transaction costs. Now, I know it sounds pretty straightforward, but as you'll see, there's a hidden pitfall here that trips up even seasoned professionals. We're going to conduct an accounting autopsy on a real-world financial statement to see exactly where things went wrong, and more importantly, how to get it right. Real quick, before we jump into the numbers, just a standard disclaimer. The views expressed in this explainer are purely the personal views of the author and aren't binding on anyone. We always ask that you seek the help of a qualified expert before taking any action, or refraining from any action, based on what we discussed today. Okay, legalities out of the way, let's set our baseline. Setting the stage for today's analysis. Our baseline functional and presentation currency is the Indian rupee, or INR. Naturally, that means foreign currency is simply anything that's not INR. Also, the reporting period we're working with begins on April 1st and wraps up on March 31st. Just standard ground rules so we're all on the same page. So here's our roadmap for today. We're going to start with Part 1, the debt securities disclosure. Then we'll decode the Ind AS 109 rules in Part 2, move on to the compliance verdict in Part 3, and wrap up with the GAAP Advisors Services portfolio in Part 4. All right, let's jump right into Section 1, the debt securities disclosure. This is our evidence. Now, this is where it gets interesting. This observation actually comes directly from the published Ind AS financial statements of a listed company. These financials were downloaded and independently reviewed by GAAP advisors on a suo moto basis. Basically, that means we took the initiative to examine these publicly available documents ourselves just to find some great learning opportunities. And when we were reviewing Note 17 regarding debt securities, we spotted something a bit peculiar. The company explicitly disclosed its unamortized transaction costs, completely separately from the financial liability itself. Because they separated those costs, the company ended up accruing interest based purely on the rate specified in the contract, while amortizing the transaction costs on an entirely independent track. Just picture it like this. They put the liability in one bucket and the transaction costs in another. Which leads us perfectly into Section 2, decoding the Ind AS 109 rules. Let's check the rulebook and see if that two-bucket approach is actually allowed. If we pull up paragraph 5.1.1 of Ind AS 109, it lays it out pretty clearly. It says that at initial recognition, an entity shall measure a financial liability at its fair value, plus or minus transaction costs that are directly attributable to issuing that instrument. So here's the absolute crucial point. If you're measuring debt instruments at amortized cost, your initial fair value measurement has to inherently be adjusted for the transaction costs. You don't get to just park those costs in a separate accounting silo. By adjusting the initial carrying amount right off the bat, those transaction costs become mathematically baked into your effective interest rate over the entire life of the instrument. And Appendix A really drives this home when defining the amortized cost of a financial liability. It mandates that you take that initial measurement amount, which, remember, already has those transaction costs baked in, minus principal repayments, plus or minus cumulative amortization using the effective interest method. You literally cannot use the effective interest method properly if your transaction costs are stripped out and amortized separately. That effective interest rate is designed to smooth out the true total cost of borrowing across the term of the debt. If you're just relying on the nominal contract interest rate, you're totally ignoring the economic reality that those transaction costs changed your actual effective yield. Okay, moving to Section 3, the compliance verdict. We've got the evidence, we've got the rulebook, it's time for the diagnosis. Let's literally put these two approaches side by side. On the left, we have the company's method. They kept unamortized transaction costs totally separated from the liability, and because of that, they just accrued interest using the standard contract interest rate. Now, on the right, look at the mandated Ind AS 109 method. The carrying amount of the financial liability itself must be adjusted by those transaction costs at initial recognition. That means you absolutely must use the effective interest rate to amortize the blended amount over time. So the takeaway here is pretty undeniable. Because the company disclosed unamortized transaction costs separately, the carrying amount of their financial liability was inherently incorrect from the start. It just wasn't measured at amortized cost as defined by the standard. Consequently, the interest rate they applied was simply the contract rate, not the effective interest rate. So our diagnosis is crystal clear. It's perceived that the company has not complied with the strict requirements of Ind AS 109. All right, Section 4, the GAAP Advisors Services portfolio. Catching errors suo moto is awesome for learning, but let's talk about preventative medicine for your own organization. The observation we just unpacked was actually featured in the 207th edition of the GAAP Advisors Task Weekly newsletter, which is authored by CA Manish C. Iyer, Director of GAAP Advisors. To date, there have been over 230 editions published. If you're on LinkedIn, I highly recommend subscribing to the newsletter for free. Also, you absolutely need to check out the massive issue repository over at gapadvisors.com. It hosts over 4,500 real-world issues and their responses on Indian accounting standards and Indian GAAP. Anyone can register for completely free and submit issues for a detailed response delivered right to their inbox. It is an absolute game changer, particularly for auditors who need to rigorously document exactly how they addressed complex Ind AS application issues in their audit files. Look, you really don't want to wait for a Suomoto review to uncover a glitch like this in your published financials. Get your financial statements reviewed by GAAP advisors before you even sign them. And hey, if you're an investor looking at listed companies, an independent review for Ind AS compliance can give you a huge edge in making proper buy, hold, or sell decisions. It's super easy. Just submit your financial statements in a near-to-publishing PDF format by email straight to info@gapadvisors.com. If you're looking to really master these standards, here are your next steps. First, if you've got specific, complex issues, you can book a one-on-one consultation directly with the author on his topmate.io page. Second, if you're a fan of audio deep dives, we definitely want you to connect to the GAAP Advisors Ind AS Clinic podcast. You can find it on Spotify, Amazon, or right here on YouTube for an extended breakdown of the observation we dealt with today. So I want to leave you with this thought-provoking question. Are hidden transaction costs subtly compromising the integrity of your own financial statements? It's a seemingly small detail, but it fundamentally shifts your effective interest rate and, ultimately, your bottom line. Thank you so much for hanging out with us today. If you found this explainer valuable, please hit that like button. Add your thoughts or questions in the comments, and definitely subscribe to the GAAP Advisors Ind AS Clinic channel if you haven't already. And one last favor. Please share this explainer with your contacts, your colleagues, your audit and finance teams, and especially among students pursuing their CA course. Together, we can spread the knowledge of Indian accounting standards everywhere. Until next time, keep those financials accurate, and we'll see you in the next one.